You're listening to Capital Topics, episode number 75. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll review the key findings from the 26th edition of the UBS Global Investment Yearbook for 2025. Enjoy! Good morning, James. How are you today?
I'm very good, François, and how are you?
I'm good, thank you. So I'll start this off for listeners. Our topic today is a review of the 26th edition of the UBS Global Investment Returns Yearbook 2025 Summary Edition. Reviewing the yearbook is an annual ritual for our podcast. This is the second year it has been published under the UBS brand. This change came about because of the merger of Credit Suisse and UBS. This is the fourth year we publish a podcast covering the UBS Global Investment Returns Yearbook, and the content from the prior yearbook is still very relevant. I would also like to highlight that the yearbook is published by UBS in collaboration with Professor Paul Marsh and Mike Staunton of the London Business School and Professor Elroy Dimson of Cambridge University. They have been involved for all 26 years. This being said, James, could you give our listeners an intro about the yearbook and explain its purpose?
Okay, François. So the purpose of the yearbook, really never changes much. The yearbook presents a historical record of the real returns from equities, bonds, cash, and currencies for 35 major markets spanning developed and emerging markets and stretching all the way back to 1900. Its purpose is not to make forecasts, but instead to inform investors about long-run capital market performances, to interpret them, to analyze them, and then to learn from all that data. And hopefully it helps illuminate, our current concerns or thoughts about markets.
Right.
The yearbook content always comes back to the anchor of risk and reward and the importance of diversification and asset allocation. This, as our regular listeners know, François, is core to our investment philosophy.
Yeah, correct. So now, James, I'm going to start off today's review by asking you the same question as in prior years. Why do you find the yearbook useful as a portfolio manager?
Well, François, my answer is going to be the same as in all prior years when we did a podcast on this topic. Our discipline is to invest with an investor mindset that is focused on the long term. We don't want to be led astray by short-term noise in the financial media and the recent, financial market volatility. This challenge is daunting, and it applies to all investors, including us professionals. We have said it often in our podcasts. It is simple to say, but it is not easy to do. We must always be cognizant that we can fall into a trap of trying to forecast the future. This is why the yearbook is so useful to us as portfolio managers.
Yeah, I totally agree with you, James, on this. The yearbook helps put current financial market events into context by comparing them to long-term capital market history. This year's edition focuses on diversification. The rationale for that is the U.S. market concentration. The yearbook states that it is now at the highest level for 92 years, and the 10 largest companies globally now account for around a quarter of global equity value.
Yeah, well, we've covered this particular topic, the MAGA stocks and the concentration, and how U.S. equity is, in the last 10, 15 years, become a much bigger part of the weight of global equity markets. But there's also another flip side of all of this, which is really important that the yearbook highlights, and that's rising correlations between markets, both developed and emerging, and also between equities and bonds. And of course, this increased performance concentration driven by the largest companies. So our discipline of being globally invested, though, has really paid off this year as U.S. equity markets have been much more volatile than other equity markets.
Well, James, if we look at the April 30th, 2025 PWL market statistics page, we can find the year-to-date results for the global equity markets, and the numbers I will be stating are in Canadian dollars. The U.S. total market is down 9.2% year-to-date as of April 30th, and since reaching the peak in February, it's down 14.2%. That being said, Canadian equities with the S&P TSX Composite is up 1.4%. International developed equities are up 7.2%, and emerging markets are flat at 0.1% return.
So those results may surprise a lot of people. And that's why a globally balanced portfolio is down a lot less than something that's overly concentrated in the U.S.
Correct.
equities. So as we discussed in our podcast earlier this year, François, in the last 15 years or so, U.S. equity markets, the returns there have dominated other equity markets. It hasn't even been close. And this has basically led many investors to question the benefits of being globally diversified outside of the U.S. But this year, we finally see the benefit. As in our prior yearbook reviews, market history teaches us that we have to accept that sometimes diversification doesn't pay off.
Yeah.
The yearbook data helps us appreciate that it really pays off, but over very long-term horizons. And so you will get that benefit.
This year's yearbook, James, highlights 10 key insights of market history considered in the study. So let's start with the first insight. And I quote, "In 125 years of market history, markets have changed dramatically."
Indeed, they have. And it's really interesting to look at a chart they produce in the yearbook. And it shows that markets at the beginning of the 20th century were dominated by railroads. So think of it. 63% of the value of the U.S. stock market in 1900 was railroad stocks. And in the UK, it was just almost as concentrated at 50% in railroads. So meanwhile, of the largest industries now in 2025, energy, except coal, obviously, technology and healthcare, including pharmaceuticals and biotech, were almost totally absent 125 years ago.
Right.
So telecoms and media, at least as we know them now, are also really new industries.
Right. The yearbook makes the point that the markets are very different from what they were in the 1900s. The leading stocks today are not the leading stocks from the early days. I could even say that they're not the same stocks as 20 or even 10 years ago. We have addressed this many times in our podcast. More recently in podcast number 67, we reviewed the Professor Bessenbinder's research, where he found that most long-term equity market gains can be attributed to a very small number of stocks. His research also demonstrated that how difficult it is to select them in advance. I believe that Bessenbinder's research kind of connects with the yearbook indirectly by highlighting the change in composition in the equity markets leaders over time. So now, James, let's look at the second insight from the yearbook, and that's the outperformance of stocks has been striking.
Absolutely. I mean, stocks has way outperformed, T-bills and bonds, et cetera, and inflation. But equity returns, as everybody knows, are volatile. So there's no surprise there. But it takes a lot of historical data points to obtain a realistic understanding of what long-run returns can tell us about the future. The yearbook really helps on that front, and it confirms that the annualized returns from 1900 to now for global equities is 9.7% versus 4.6% on bonds, 3.4% on T-bills, and inflation is averaged over this period of 2.9%.
Interesting. Now, James, for the third insight, real returns on government bonds have been modest.
Again, no surprise there, François. Last year in podcast number 61, where we reviewed Professor Scott Cederberg's research, he proved that bonds perform poorly after inflation over the long term, and he made the case that people should consider being 100% in equities, depending on their risk tolerance. The yearbook shows that the data from 1900 to 2024, so again, as I've said a couple of times now, 125 years of data, were not especially kind to investors in government bonds. And I quote the yearbook, across the 21 continuous history markets, the average annualized return was 0.9% in real terms, and 0.6% if you included Austria's very low numbers. While bonds have generally been less volatile than equities, they have also experienced some protracted periods of very low or high returns. Since 1900, the average standard deviation of real bond returns across countries was 13.2% versus 23% for equities and 7.5% for T-bills. So 13.2% volatility on real bond returns. That's a much higher vol number than people expect.
Yeah, correct. There was a lot of jargon in what you shared, James. Let me simplify this for our listeners. Surprisingly, not only do bonds generate very little real return, there are periods when they can be volatile, as we saw in 2022, when bond returns were negative. So now for the fourth insight, it hasn't always been a smooth ride.
Well, François, every investor knows that equities are volatile. Again, we just talked about it a few minutes ago. That's why we expect to get a higher return than investing in safe assets. Risk and return has to be related. Mm-hmm. Yearbook highlights that investing in equities has proved rewarding over the long run. In an average year, the real return on U.S. equities was 8.5%. The range of outcomes can be very wide. During the 125 years under study, there were 6 years with annual returns below negative 40%.
Wow.
But on the other hand, there were 6 years of returns over 40%. So, you got to take the good with the bad.
Yeah, quite a big difference there in returns. So now for the fifth insight, patience has been valuable.
Okay, so that's a bit of a motherhood statement if I say so myself. But as we all know, François, most investors what they're really afraid of is a deep bear market that's going to last a long time.
Right.
The yearbook covers the 4 great bear markets since 1900 and plotting their drawdown and recovery times. If we look at the last 25 years, for example, the tech bubble burst in March of 2000. U.S. equity prices again collapsed, and the full drawdown and recovery period lasted 7.5 years until July 2007. The subsequent global financial crisis in 2008, 2009 saw the market reach its bottom in February, early March 2009, I guess, on the S&P 500. The market then took 4 years to recover from there.
Yeah, but that's the time it took to recover from the bottom. But the full cycle of when it started dropping to when it recovered fully took 5.3 years. The worst period, however, was the Great Wall Street crash that took 15.5 years to fully recover. That was in the early 30s. Now, moving on to the sixth insight, multi-asset diversification has helped manage volatility.
Multi-asset diversification. That's more jargon for our listeners here, François. But what we're really trying to highlight, or what the yearbook's trying to highlight, is the diversification across asset classes has been a good way to reduce portfolio risk over the very long term. And what they are also talking about is the need to find assets whose returns are not always in sync. So when something goes up, the other thing may go down, but when something goes down, then that other thing that goes up will offset. So we addressed this topic of correlation of asset class return 2 years ago after the terrible year in the bond market in 2022. And so the yearbook shows that stock bond correlations over time are higher than what people think, and that recent history is maybe more of an anomaly. So over the very long run, the yearbook says the stock bond correlation has averaged 0.33 across countries, and it's at 0.19 in the US. These are low correlations, so you will get a diversification benefit for risk reduction by diversifying across stocks and bonds. But this is where, the recency bias comes in, because over the more recent shorter periods, so let's say we take the late 1990s to 2021, stock bond correlations were actually predominantly negative. And that was like a real free lunch, a great free lunch for investors.
Right. As we have seen, the era of negative correlation came to an abrupt end in 2022 when stocks and bonds fell sharply together. But the yearbook makes the case that over the long term, bonds are positively correlated to stocks. So next up, the seventh insight, there's a compelling case for diversification within equities.
Well, absolutely. And again, if we break that down and unbundle it, we've talked about this a lot over the years on our podcast. On the one hand, when markets have been deeply volatile, they tend to move together. But the yearbook makes the case, as it has in the past few years, for the potential risk reduction benefits for international equity diversification and international bond diversification. The yearbook shows that over the last 50 years, globally diversified portfolios generated higher Sharpe ratios, and that's a ratio developed by William Sharpe, where, if somebody only invested in their domestic markets of the various major countries. So for our listeners, the Sharpe ratio is a measure of an investment's risk-adjusted return, essentially indicating how much return the investment generates for each unit of risk taken. So are you adding value or are you subtracting value?
Yeah. This makes total sense for Canadian-based investor, particularly if they have invested in U.S. equities, since over the last 30 years, U.S. equities have outperformed Canadian equities. Now for the eighth insight, which is inflation is also an important consideration in long-term return. It's often claimed that equities are a hedge against inflation. However, the yearbook restates a fundamental fact. Equities tend to perform especially well in real terms when inflation ran at low level, while high inflation impaired real equity performance.
Well, the 2024 yearbook also made this case, François, and I quote, "Equities have enjoyed excellent long-run returns. They are not and have never been the hedge against inflation that many observers have suggested. Rather, stocks should be seen as an excellent inflation beater due to the equity risk premium." And that's an important nuance investors really should always keep in mind.
Yeah, correct. So now we move on to the ninth insight. Gold and commodities can play a role in hedging inflation.
Well, again, we read the research. Again, they talked a lot about this in last year's yearbook. But we haven't been a fan for private investors to do this because, frankly, you can't get the retail products that are investor friendly, low fee,
Right.
tax efficient, etc. But for large institutional money managers that have teams that can track this and hedge and trade, and they may add value by adding this asset class, but we don't believe would be the
for
case
retail,
for private
it's much more difficult.
investors. Yeah, in taxable accounts especially.
Yeah, I totally agree with you here, James. And finally, the 10th insight, factors have delivered long-term outperformance, but some styles have disappointed for years.
Well, we've been managing our client portfolios with dimensional funds for the better part of 22, 23 years now. And, they're really efficient tools to capture size, value, and profitability factors. So again, it's been a big part of our portfolio management solution for clients for a long time. The yearbook states that factors have outperformed broader equity markets over long time horizons. However, it also states that premiums can be negative even over entire decades. And so we've lived that, particularly with the small cap premium. But growth has outperformed value, again, driven by those large mega stocks in the US for a long, long time now.
James, here I agree with the yearbook when it states assessing whether factors will generate premium in the future is a difficult call.
Well, you can also argue it's got a form of timing the market, and you can't bet on mean reversion. That all of a sudden the investor psychology is going to give up on growth and go towards value. So, but we've seen in the last decade where large cap beat small cap and growth beat value. The yearbook again makes the case for factors based on data going back to 1900, and I quote: "Nonetheless, size, value, income, momentum, and volatility will continue to have an important impact on portfolio returns and should be monitored by all investors. So they are important in performance analysis and evaluation and in distinguishing between style returns and stock selection or timing skill."
Yeah, but it can take a while to benefit from factor tilts. We've experienced it over the last several years, but as they say, and I quote, the long run can take a very long time.
Well said. Uh, Another point I'd like to make, François, and there's an interesting statement in the yearbook, and I quote, I think our listeners will find it useful. The 21st century is now 25 years old, and measured since the start of 2000, stock returns have been lower than over the 20th century, though global equity investors still enjoyed an annual real return of 3.5% and an equity risk premium relative to T-bills of 4.3%. But that said, François, we addressed it in last year's podcast for the 2024 yearbook review. Expected returns going forward are going to be lower. So investors need to appreciate that the long term in investing is much longer than they realize.
Yeah. Investor need to understand that the long term is not 10 to 20 years. It's much longer than that. Finally, James, what takeaways does the yearbook have for listeners concerning global diversification?
Well, again, tried and true principles. So there's nothing new here, François. As we've often discussed in our podcast, diversification is a key part of our investment discipline. The power of diversification across stocks, markets, and asset classes helps to reduce but not eliminate risk. Mm-hmm. So over the last 50 years, except for US-based investors, investing globally for investors led to better risk-adjusted returns than investing only in their home markets. And reaping the benefits of diversification is a long-term strategy, but it can let you down in the short term. Again, recent history, the historically extreme negative returns of 2022, where both bonds and stocks went down very unusually. It was the worst in 120 some years. So that's a really, really good reminder for our listeners that diversification really is a long-term strategy, and you have to be patient.
Yeah. Good investment decisions based on sensible criteria can sometimes have disappointing outcome. This brings us back, James, to the importance of long-term perspective and with an appreciation of the laws of risk and return. I recommend that our listeners always consider the long-term goals, their risk profile, their ability to take risk, and their time horizon when building their portfolios.
So, François, as our listeners well know, we have experienced 4 equity bear markets since 2000, 2 really deep ones, and we need to be paid for taking risk. So the risk premium for investing in stocks, it exists for a reason. It is a necessary payment for the risk of volatility and the potential of large drawdown.
Yeah, correct. So I hope our listeners have found our review of the UBS 2025 Global Returns Yearbook useful to helping them make smart decisions with their long-term money. We'll make sure to put a link to the UBS Yearbook in this podcast page. And as we said at the outset of this podcast, the value of the yearbook is that it always comes back to the perspective of risk and reward and the importance of diversification and asset allocation. This, as our regular listeners know, is core to our investment philosophy. So thank you, James, for sharing your thoughts and expertise again today.
My pleasure, François.
So that's it for episode number 75 of Capital Topics. Don't forget, if you'd like to submit a question or a suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on June 11th. In the meantime, make sure to consult the Capital Topics website for all our latest blog posts. See you soon. Thank you.